Good afternoon, everyone. Welcome to Perpetual's AGM. This will be the Investment Manager update. I'm going to take you through a few slides reviewing the year that we've had, also some of the stock ideas, and I'll introduce you to a couple of analysts. Starting off with our investment philosophy, this is our core beliefs. We go through this every year. I think for newer investors, I think it's important for them to understand what we do. When we look at our four quality filters, as we refer to them, these are the minimum requirements for any company to be considered investable. So when you start off with the quality of business, this is where we look at the industry that the business is operating in. We're trying to assess the future risks of the business, the returns of the business, and looking for any structural shifts that may occur which may affect future returns. Moving to debt, we have a very strict balance sheet metric. We don't like companies that have excessive amounts of debt. We have a minimum requirement of EBIT interest cover of 3 times or greater. And for cyclicals in particular, at the bottom of the cycle, the business cycle, we expect them to be at 3. So they have to average above that through the cycle. Then we look at management. This is where we assess the management. We look at the track record of the management, assess their ability to add value to shareholders. We look at the strategy the management has and whether they can execute on that. We assess the remuneration packages of the manager, see that they're aligned with the shareholders and that the shareholders will benefit from that. Over the long run, there's a high correlation between REM being aligned with shareholder value creation and good returns. And finally, we look at recurring earnings. Now, we don't buy concept stocks. All the companies we look at need to generate a profit. In the short term, when things are exciting, people like to buy new companies which have a potential of vast returns eventually. In the long run, though, the success rate of that's quite low. So in the short term, it tends to hurt us. In the long run, though, it tends to protect us when we have market dislocations like we've just been through. Now, given our style, one of the biggest risks as investors is that we fall into value traps. I thought I'd walk through an example. We owned this company before, very early on in the day, as a PIC listed about 5.5 years ago. It's called Sky TV. Now, when we look at Sky TV, it's a pay TV operator. It runs a linear programming model where you can't choose your event. Originally, you could not choose what program you could watch, just what was listed in the programming guide. Now, what happened was, what we underestimated was the customers, the newer competition to Sky TV, which is the telecommunications companies and some of the retailers. They were buying pay TV content rights and they were bidding that value up. Now, those competitors were actually selling that product as a loss leader. So they actually had no intention of making money on selling that product. It was actually trying to lower their customer losses and customer churn. And this is something that Sky TV, which his entire business was to buy content well and try and make money out of that content, was facing the irrational competitor. Secondly, we had direct consumer type content offerings and operators. Obviously, the one that everyone knows is Netflix. Netflix and those sort of businesses, the streaming players, were being rewarded for growing revenues and not profit. So they're able to pay up for content and generate subscription growth, which effectively was an unlevel playing field. Sky TV was based on profit growth, whereas their newer competitors were based on generating subscription growth, whether it was profitable or not. So basically, Sky TV was buying content and trying to sell it and trying to make a profit, whereas the peers were happy to resell it at a loss. And this lasted longer than we actually expected. The other thing we underestimated was subscriber losses. Historically, Sky TV, given its programming, had really great and a lot of strength in sports programming in particular, and all the rugby rights, etc., in New Zealand, and a lot of the sports. And we were of the view that there was some part of the base of the subscribers, the customers of the company, that would churn off over time and then get ever rusted on call. Now, with the new streaming type of businesses, what we discovered was a lot more people were willing to not want to watch the whole content suite that Sky TV was offering, which is movies, etc., news. We're happy to just buy sports. And that did occur where some of the sports rights were sold to another operator, a telecommunications company, and people actually churned it off. So we underestimated the level of loyalty to Sky TV. And finally, management. Now, you need new skill sets when things change. Now, existing management were renowned for being excellent at acquiring content and sports rights, great content negotiators, and were had a monopolistic type position in some of the programming areas. But they weren't as tech savvy as the new competitors, and that led to quite a poor product release when they sort of launched their own streaming type service, a more a la carte style programming product. And that came at a critical time for the business. It's quite damaging to the business. We did learn several things about this. When you make investing mistakes, you have to go back, assess what you did wrong. When managers facing a new operating arena with direct-to-consumer and some irrational, non-core competitors like telcos, etc., using the existing box of tricks doesn't typically work. It's time to move on. Traditionally, nobody wants to disrupt themselves. It's typically not in their REM package, especially. Who like to hang on to what they've got. Now, if the market's willing to reward companies for selling products less than they cost, then you need to reassess your business model. And what you need to do is work out whether you need to be in the industry, sell out, break yourself up, work out how to a way to generate some value add for the investor. And the third thing we learned is do not look at regulatory and competition policy through the lens of any sort of common sense. Traditional media companies over the last 15 years have been held back greatly by outdated regulatory rules, while new media like Google and Amazon, etc., Apple, all those entrants were unfettered in what they can and can't do. Sky TV tried to merge with Vodafone New Zealand a few years back, which we thought made sense. Vodafone had a great product in its wireless offerings. It could also stream anywhere you wanted to, with the device of the mobile phone. You could stream content potentially. And this made a lot of sense to us. We actually put a submission into the competition inquiry when they were looking at the transaction saying, given the level of competition from non-regulated operators, it sort of makes sense that this will not lessen competition. Now, that got knocked back on competition grounds. The ensuing 3 years have shown that decision really weakened Sky TV, and it's not in any position to compete aggressively. Moving on to the next slide. We look at markets today, they're quite buoyant. There's been a sharp recovery, especially since the March lows. But given the structure of markets today, you look at the market cap of the US market in particular, it's about $36 trillion. The GDP of the country is about $19.5 trillion. And this is a traditional measure of market cap to GDP. It's at about 184%. It's probably pretty much the highest it's ever been. Now the market actually, when you look at the participation of the market, what's driven it, it's been driven pretty much by a handful of tech leaders. So you need to be wary about the structure of the market, what's driving it. You need to, we think you need to diversify away from being really exposed to a narrow group of expensive mega caps. When you look at the US election as well, that's a thing we have to consider down the track. Now, over the medium to long term, it really doesn't matter which side wins, because over history, it's proven they're pretty close to being not that different in policy. It's the edges, there's some differences. But if there's a year 2000 type election where the election result is contested and there's no real knowledge of who has won for months and months, markets don't like uncertainty. That's a real risk that this may occur. So we're in a position now where you've got an election, you've got a market which has been pretty much driven by a few very large stocks, thematically in tech mostly. And you've now got significant amounts of fiscal stimulus globally being used as a tool to offset the impacts of Corona, and actually more, not the impacts of Corona, but the impacts of shutting down economies. You look at Europe, they're starting to temporarily close the economy down intermittently. That's causing a bit of havoc in Europe as well. So these are the things you've got to consider about, look where we are in a market and what valuations are telling you, what are you paying for, what are you getting for what you pay for. In Australia, we've actually, outside of Victoria, managed to pretty particularly well. Now, we have used the credit card to try and get through this. It's the largest stimulus that's ever occurred in Australia. You've also got the central bank providing significant record amounts of monetary stimulus. You know, we have quantitative easing, which has never happened in Australia. But one thing, I'll talk about those in a moment, but one thing we really got to think about, and this is a structural shift, is the slow burn problem of immigration in Australia now. We are a migrant nation, and 2/3 of our population growth has been from migration, net positive migration. Now, with no cross-border movements, we might see the biggest decline in growth since World War II. The government's tried to fill the gap with fiscal largesse. But if we don't get the immigration machine working again by the end of 2021, we'll actually have potentially declining population. And this will have an impact on aggregate growth and house prices and just all the things which have benefited from a net positive population growth. Most of the fiscal stimulus is going through the private sector, so it is being used to either invest in new plant. You know, the recent budget suggested instant asset write-off, so it's encouraging businesses to invest today and get the tax benefit of that today. These are all benefits to the economy, but I feel that they are pulling forward a lot of demand, artificial demand, rather than let it go. So we've got to start thinking about what happens post these sort of changes in policy. So the economies are really heavily reliant right now on record amounts of fiscal stimulus and central bank accommodation. That is not normal to have for a healthy economy. So at some point, these things will need to be pulled back. And in Australia, we've got quantitative easing. Now, we have to think about that because the UK experience in particular, which has a similar banking market like Australia, what you've seen is, you can get loans below 2% right now, but net interest margins for the banks, when you've got a cash rate of 0, you start to see net interest margins of home loans start to decline. And what typically occurs is non-bank credit providers can come into the market because they can finance capital markets quite cheaply, given where credit spreads have gone down to. They tend to compete away. They haven't got a legacy book to protect like the major banks, so they'll tend to compete away at the margin so they can grow their book. Now, this is an issue you have to think about, that right now banks are priced, they're all three of them are trading below book value. They're priced for a pretty dire outcome. We think that there's some value in the banks here, but more importantly, what's structure look like if we persist with record low rates is that it's going to allow or invite competition in the housing market in particular. So moving on to the next slide, we'll look at what lies ahead. Our strategy of keeping the portfolio quite balanced between some reasonably priced but high quality businesses that have some structural growth tailwinds, as well as looking at some undervalued cyclicals because of the depths of the economic slowdown. A lot of the cyclical stocks were, as typically occurs, were overly punished for what we believe is a short-term economic outcome. And then to have a balance between some high-quality structural companies, which you could buy early in the period in March, April, because everything was thrown out at the same time, and buying some cyclical companies which will benefit as things normalise, as earnings rebound back to close where they were before. If over the last 12 months, you look to September, the S&P 300, ASX 300 is down about 10%. Fortunately, the portfolio after fees is up about 3%. I'd like it to be higher, but that positioning, that having some structural tailwind stocks and some cyclicals, it's positioned the fund to beat the market by about 13% over the last 12 months. So we're actively managing our exposure, and it's really critical to manage that, have those ability to have a foot in both camps and not be stuck in one way of just looking for, we'd all love to own the best companies all the time. It's great, but they tend to be priced at levels which don't offer you a lot of protection. The other thing that benefited the PIC in the last 12 months has been cashed up. So the benefit of having an ability to go up to 25% cash has been critical, because we came into the crisis with about 16 or 17% cash. But more importantly, we can use some derivative products for hedging. So we bought some put options in January, which is basically we're saying that we're concerned about the market level. We want to buy protection over our existing holdings. I would have preferred, I didn't want to sell our existing holdings to raise more cash, because I thought some of our positions were quite cheap. So we bought some put options, and the benefit of that was because the volatility in January, February was extremely low, the cost of that insurance, that's what it is, it's insurance, was negligible to the portfolio. Now, having a lot of cash and some derivatives to protect the downside sort of helped us buffer some of those impacts of what happened in March and April. More importantly, as a portfolio manager, what it allowed me to do is, okay, given that buffering for the extreme moves that we saw, but more importantly, I didn't have to sell positions when the market got cheap to buy other positions which looked better opportunity. I actually had cash on hand to actually buy, not sell what we got, but buy, double down on some of the stocks we own, which we really liked, and more importantly, buy newer positions. And again, we're trying to maintain that balance of having those structural growers and cyclicals, which have outperformed really well in the recovery. Now, I think it's right to maintain that balance at this point in time, because the economic outlook's not as clear as it used to be. It was easy to buy the market in March, April, because everything tends to normalise. We're now at a point where the market's pricing that everything is normalised. So moving on to the next slide. I just wanted to highlight, this is an important chart because it's important for the investors of the PIC to understand. We don't tend to try and sit in one part of the market like we want to be a large cap fund, etc. The PIC's investment mandate is quite flexible in that we can go up to now 35% in global, up to 25% in cash. It allows us to move around the market cap curve and also leave the Australian market and look for relative value and potentially better ideas offshore to add to our portfolio. You know, we want to give exposure to investors to non-large caps, so operating mid caps and small caps when the value's there, but also that global stocks gives us quite a bit of flexibility. You know, earlier this year we bought a range of stocks outside the top 50, including Flight Centre when they did the capital raising, and Nick Scali, etc. These things traded at extremely low valuations in our opinion and the work that our analysts have done. This allows us, this style investing, to be able to move around the market, allows us to harvest the alpha across the whole market cap spectrum. And this has been a key feature of what sort of helped us in the last 6 months. And as you can see from the chart, we were very low in exposure to global stocks earlier last year especially, and we're quite overweight large cap stocks and underweight the mid cap sector, part of the market. That's, for us, it's valuation driven and opportunity driven. We're finding it difficult to find of those opportunities in those parts of the market. So as you can see, it's quite dynamic. We're actively managing the portfolio to try and generate an outcome for our investors. So you expect that to continue. That did have questions last year about our global stocks where our weighting was too low. We're opportunities based. We wait for things to come to us. Now I'd like to introduce two of our analysts, equity analysts, who will be presenting on stocks in the portfolio. The first one is Fremder. He's an equity analyst responsible for small and micro cap companies, and he'll be presenting on PWR Holdings. And after Dean is Clarke Wilkins, who's a senior analyst at Perpetual Investments. He's responsible for resources and energy companies, and Clarke will cover the investment case for Western areas. Over to you, Dean.
Thank you very much, Vince. As Vince mentioned, I'm Dean Fremder, and I'm an equities analyst in the Perpetual Investments team. I'm going to be talking to you today about a relatively recent addition to the portfolio, which is PWR Holdings Limited. So PWR is a real hidden gem of a business. It's a family-run company which was started almost 30 years ago in the Gold Coast. And from a standing start, the CEO, Kees Weel, has built what is a world-class high-end engineering business focused on bespoke cooling solutions. So that's mainly radiators intercoolers, and cold plates that are used to cool down mechanical and electronic parts. The company's primarily focused on elite motorsport teams, so names like Ferrari and Aston Martin, up until now, but going forward, they're increasingly focused on new applications for their technologies, including areas like electric vehicles, autonomous vehicles, and even some aerospace and military work. And so if we just go to the next slide. So at Perpetual, we evaluate all businesses through the lens of our 4 key quality filters. And I'm going to run you through those today as they pertain to PWR. So first and foremost, the quality of the business. And when we think about quality, it really is a question mark around, does this business have something special that means it's going to be able to continue growing for a long time in the future, and also something special that prevents competitors from taking a large part of their share away from them. In PWR's case, they make highly bespoke products which their customers love and which have actually become very, very vital parts of their customers' supply chains. And so those great products and their long-term customer relationships means that they actually very rarely come up against competitors at all. And from a financial perspective, their customers are very, very sticky, which allows them to generate pretty amazing after-tax profit margins of 20% and a fantastic 25% return on their equity, which is enviable for most companies. The second thing we look at is the gearing levels in a business. And really, we're trying to understand whether or not they have too much debt. Ideally, we'd like them to have no debt or a minimal amount, which enables them to have a lot of flexibility to work their way through whatever situation the world throws up at them. In PWR's case, they actually have no net debt at all, which gives the company a lot of flexibility for exactly that, for when times get tough, like the last 6 months have been for most companies. And then importantly, they've also got a track record of generating very consistent, strong free cash flow year in, year out, which helps them fund their growth. The third thing we look at is the quality of the management team in a business. And in smaller companies like PWR, management is more important than anything. Ultimately, they are the drivers of the bus that is going to take the company in the direction that they choose. And so it's very important to focus on whether or not we have faith that management will be looking after our capital in the right way. In this case, the founder of the business, Keith Wheel, is still the CEO today, and he runs the business with all the passion and accountability of a family business. We love that, and in fact, we love the team that he's built around him. Keith owns just under 30% of the company himself, and so our interests are very aligned as shareholders, also a great point. And then one thing that really isn't talked about that much in investing, but is incredibly important, is the internal culture of the business and just how much that is able to drive either good or bad outcomes for a business. It's very difficult to assess from the outside, and it requires a lot of work in speaking with customers and suppliers and ex-employees. But through our work on PWR, we've come to the view that the culture is really something special, and we actually think that's a major driver of their success to date and likely their success going forward. And then finally, we look at whether or not a business has a track record of profitability, which in PWR's case, it certainly does for a long period of time. And we also expect many, many more years of double-digit earnings per share growth ahead, as they not only capitalize on these new markets, but also find new ways of selling additional products to their existing customers. And so if we move on to the next slide, amidst the market sell-off in March, the stock actually fell 50% from its highs. And that was primarily because global motorsport events around the world were being cancelled, all the Formula One races and NASCAR races and whatnot. And the market got very worried about this key source of revenue for the company, though in our work, we believe the impact to be temporary. On top of that, the company's lack of debt meant that we just didn't need to worry about their ability to survive through some lean months. And ultimately, we realized the opportunity to acquire what we believe to be a very, very high quality business at what was an attractive valuation at the time. So we started to build our position on the way down. Unfortunately, you're never able to get the exact bottom, but we certainly tried. And now as we look at the world around us, the world is slowly recovering. Motorsport races are back on. The company's pipeline is as full as it's ever been. And the stock, fortunately, has recovered strongly from its March lows. And then just to the next slide, putting it all together, what we see in PWR is a really high quality business run by a highly incentivized founder CEO. The company generates reliable free cash flow, double-digit earnings per share growth, and it earns an enviable 25% return on its equity year in, year out. We see many years of significant growth ahead as the company dips its toe into these new markets I talked to before, including electric vehicles, autonomous vehicles, and some aerospace applications, where each of those individual markets could prove to be very large for PWR over time. And then most importantly, we were able to acquire our stake at a valuation that we deemed to be very attractive amidst the global meltdown in March. But thank you very much for your time, and I'd like now to hand over to my colleague Clarke to talk about Western Areas.
Thanks, Dean. Good afternoon, everyone. As Vince mentioned earlier, I'm Clarke Wilkins, the equity analyst covering the mining and energy stocks for Perpetual. The stock I'm going to be talking about today is Western Areas, which is a small cap mining stock we recently established a position in. Now, Western Areas is a WA nickel producer. I've got 2 existing mines, and they're also developing the Odysseus project, which will have a significant long life. This company has conservative levels of debt. It's got a low cash cost position, got sound management, and we expect them to generate strong earnings from the new project, especially as we see a bullish outlook for the nickel market. Moving to the next slide, when we're investing in a commodity company, it's critical to get the underlying commodity view correct. The reason why we like nickel is the leverage to the electric vehicle thematic. Electric vehicles currently represent about 2% of the global sort of auto market, but over the next few decades, that is expected to grow significantly. There's a lot of forecasts out there for the demand growth for electric vehicles, but generally they're thought to make up 20 to 60% of all auto sales by the time we get to the end of this decade, and increasingly growing penetration beyond that. Now, when you look at the sort of some of the forecasts out there, Tesla alone is targeting a sort of 3 terawatt hours of battery production in 2030 from batteries. That's a very aggressive target, which is unlikely to be achieved, but it does highlight that we are expected to see some very strong growth in production for electric vehicles and therefore for battery demand. Moving to the next slide, there's a lot of sort of attention gets put on the lithium market and the leverage to the electric vehicle sort of growth. The reality is electric vehicles and batteries don't just require lithium, but they also require a number of other commodities. Nickel is particularly one of those commodities that is used in the higher density, higher energy density batteries, which are critical for this growth in the EV demand. Now, the nickel market at the moment is currently around about a 2.4 million tonne per annum market, but demand from batteries alone is expected to see that grow by around 600,000 tonnes by the time we get out to 2030. Now, moving to the next slide, the nickel constraint is a real factor in the market. Nickel is quite a rare commodity geologically, especially the sort of high-grade nickel sulfate that is what Western Areas produces from their mines in Western Australia. There's only about 30 odd years of reserve life left of nickel, and given this strong demand growth from electric vehicles and batteries, there is a real concern about where the nickel to feed into that supply that is needed to meet that EV demand growth comes from. So we've got a strong demand growth outlook. We've got a commodity which has got a relatively short reserve life. And also when you look at the type of nickel that is produced by Western Areas, it has inherently got an advantage in terms of feeding into the electric vehicle market because it goes into producing nickel sulfate, which is what is used in the production of electric vehicles. Moving to the next slide. When we look at the company itself, as I said earlier, they've got 2 mines that are producing at the moment. They are relatively short life mines, but that tends to be typical of high-grade nickel mines in Western Australia, where your reserve life or your production life is only sort of 3 to 4 years. Where Western Areas is different is that they're developing this high-grade, long-life Odysseus project. Now, this is a bit of a sort of a brownfield project. So in mining, a greenfield project is something that's a completely new operation. A brownfield is where you've already got an existing operation and you're sort of expanding it or looking to develop something that's been there before. So this was a previously mined project where there's quite a lot of existing infrastructure. What they're doing is sinking a shaft down to the deposit and also developing a new mining area called Odysseus. That project's well underway. It's expected to start production late in 2021 and then also start ramping up fully in 2022. The company is well funded to build this mine. It's got a net cash position at the moment, and combined with the cash flow from the existing operations, we see them as being very well funded to complete this project. Moving to the next slide. So to conclude, our view on Western Areas is driven by a number of factors. We like the leverage to existing nickel production in Western Australia. They're developing a long life mine in Odysseus, and they've got a strong balance sheet to be able to fund the development of that asset. There's also, in terms of a sort of longer term perspective, the potential to commercialise some of their lower grade resources in Western Australia. They've got 900,000 tonnes of nickel, which is probably not currently economic because it's lower grade, but they are looking at different technologies and mining processes to be able to extract that lower grade nickel. Or, if we do end up in a situation where we have a strong demand surge for nickel and prices do end up being significantly higher than what people expect, that could also commercialise some of those lower grade resources and provide significant upside to what is our base case for the stock. That concludes my presentation on Western Areas. I will now hand back to Vince, and thank you for the opportunity.
Thanks, Clarke. I'd now like to talk about our portfolio positioning, particularly in global listed securities. And the reason why we think it's important to have the global component as part of this portfolio. This is a stock pickers fund. We want to be exposed to the stocks we like. We don't want to buy stocks because it's in the index. And global allows us to take advantage of occasionally the Australian market will trade quite expensive, where we don't see a lot of value. And in particular, we want to provide a bit more economic diversity to the portfolio and have a more balance of risks as to what we want to be exposed to on the types of companies and the types of economies, especially, and the types of economic growth we're exposed to. A lot of the time when we are looking offshore at stocks, we tend to, sometimes it starts with, we're looking at domestic stocks and we look at the competitors offshore just out of interest or the comparable valuations, trying to do some valuation work. And that will traditionally usually highlight some companies which are as good on quality or higher quality with good balance sheets, but trading at far cheaper valuations than what we think is a real opportunity. Now, that's provided quite a bit of the positioning in the PIC in some of our global positions, but it's not the only way we do things. The Australian team, a lot of our analysts do look offshore for global comps, so they're always scouring the market. We've also got a global team in the innovation fund, the Perpetual Innovation Fund, that's looking at global stocks as well. So we've got quite a broad group of individuals looking at offshore stocks out of interest, but also out of the valuation work that we do all the time. More importantly, we're trying to find stocks that will fill up the portfolio that are not available in the Australian market. So when we can't get a particular type of economic risk or industrial risk, being able to go overseas and put stocks in the portfolio which plug gaps in what I think is an index in Australia. It's pretty much made up of banks or financials and resources, which are two sectors which are quite concentrated. So it doesn't leave you a lot in between. And then what I have in the middle is basically quite a few expensive industrial companies. So being able to go out offshore and fill those gaps provides quite a more balance to the portfolio. And there's a few examples of the next slide. So as you can see here, this is a comparison of some of the companies and the comps in Australia. So we own these, the international companies. So FDJ, Française des Jeux, it's recently listed last November. French lottery operator. It was a former government instrumentality. What we liked about it, we've done a lot of work on Tabcorp. The Tabcorp lottery business is a fantastic business. But in France, online penetration of ticket sales for lottery ticket sales is quite low. And FDJ has a 25-year license in France to sell lottery tickets. And we saw this, and if every other market you look at, those numbers are north of 30, 40%. In the Nordic markets, they're up to 80% in penetration for online sales. Why that's important is online sales have a far higher margin for the operator. And this provides a real economic opportunity and value opportunity for this business. Now, that's got to be tied to good commercial management, and that's what we've discovered in all our conversations with management at FDJ. They have a clear strategy, a clear plan as to maximise value for the shareholders and to grow the business. And in the last 12 months, though, even with, it's a newly listed company, they had to go through basically shutting down of the economy, and they actually managed through that really well. As a first test, they put out a cost reduction strategy, and once the economy opened up again, the ticket sales rebounded pretty much very quickly. It's also got a fantastic balance sheet. It operates pretty much a net cash balance sheet, which compared to other stocks in Australia, which tend to operate a lot more debt because the ticket sales are quite robust and stable. We like that opportunity because it gives optionality. Good balance sheets always give you optionality. The next company we looked at is Ferguson. We've been a long-term owner of Reece. We still own Reece in a lot of our funds. It's still a great company with a great Australian market position, and they just entered the US market. Now, Ferguson is a UK-listed company, but it's 80 to 90% of its business is actually North America, and it actually competes with Reece's recently acquired business in North America. It's the market leader in plumbing supplies and HVAC, so heating, ventilation, and air conditioning supplies. It's the biggest in the US. It only has 15% market share. It's a very disintermediated industry, so the company does grow via acquisition and plugging it into its inventory management business, and they traditionally grow the margins of the newly acquired business over time. So we liked it because it has a great business model. It's large in the US. We still think it can maintain growth. Great quality balance sheet as well, a very good balance sheet. Allows them to continue their growth via acquisition and organic means. More importantly, given the stocks listed in the UK, it trades with UK comparable type companies, whereas a lot of its competitors or like type businesses in North America trade on sometimes double the multiple. Now, fortunately, there was an activist investor that came in to shake up the business, and they've announced that they'll be listing in North America, this business, in calendar year 2021. We think with that, you'll get this re-rating of the stock. More importantly, the company, even through Corona, has hit back at every, maintained its growth and managed through the down cycle particularly well. And one of the last companies we looked at is Auto Trader. It's a similar type of company to Car Sales. Car Sales is an extremely high quality business, great management, really well run. Now, we were fortunate that we were looking at it a month or two beforehand, Auto Trader, as just getting information about what Car Sales is like, what could happen, etc. And Auto Trader went through, obviously, with the lockdown, heavy lockdown in the UK, you saw Auto Trader fall at least 30 to 40%. And the market started pricing it for some extreme earnings deterioration for the next few years. And this is a high returning business. It does return on invested capital in the 70s and 80%, high margins are in the 70%, good balance sheet, industry leader. There is some competition, but their behaviour through the down cycle when the market was closed was brilliant. They basically told all their customers to the used car sale, the car dealers, they'll forgive, they don't have to pay for listing their cars on their website. Whereas all the competitors couldn't match that. That drove market share back towards Auto Trader, which is a great strategy. And now they're coming out the other side, and everyone knows in Australia and in North America and the UK and Europe, the used car market is extremely tight now because people are out going to buy new used cars because they'd rather do that than catch public transport. So that provided a real great management, tactically smart move by the management to grow their market share. So we actually be able to pick that up on a cyclically low valuation in our view. It's now starting to approach the valuation that we thought it should trade on. So just keep an eye on that. Now, one other example I want to actually walk through in a bit more detail is a company called Persimmon in the UK. Now, Persimmon is a UK home builder. It's got several brands it builds on. It's the largest sort of home and land builder in the UK. It doesn't really build apartments. It's focused on outside the city of London. And I think it's important to understand with Persimmon where it came from, in a sense that the history of the business, and I think it's always a testament to see what happened during the GFC for most businesses. Now, Persimmon went into the GFC with quite a bit of debt. They actually they were at peak debt just before they went into the GFC. And that really exposed the company to, how everything stopped, housing stopped. It really exposed the company to significant financial risk because of the state of the balance sheet. Now, why that's important is because the company got through the GFC and that corporate memory remained. They got through that. It was a near-death experience and everyone remembers it in Persimmon. And whenever we speak to the company, they understand how sensitive their business is. Now, that's important because since 2011, Persimmon's actually operated with a net cash balance sheet. It's one of the only operators that does that. So why is it important? Because when they get to the next crisis, which we just had, which is the Corona shutdown, they easily got through the crisis. They didn't have to consider doing a very dilutive equity raising at the bottom of or at the worst of the market. Where a lot of other companies were actually forced to do that, which is value destructive to any shareholder when a company's forced to do a dilutive equity raising to basically bail themselves out at below what we think is intrinsic value. Now, let's look at the opportunity on the next slide for Persimmon. Persimmon's always had a history of paying very high dividends. Given the health of its balance sheet, we expect Persimmon to go back to paying a very high dividend again in the second half of the year. The company's already sort of intimated that will be the case. Fortunately, Persimmon's a sort of business, when you look at an opportunity, it's right now in the sweet spot. It's a landowner outside the City of London, outside the ring, the M25 ring, the road there. They're also, given the history of the business and the structure of the UK housing market, they're actually vertically integrated as well. They own their own brick and roof tile manufacturing plants. One little known fact is that the UK actually imports its brick because there's short brick manufacturing capacity because of the cost of energy. And this is important for managing the margins of the business through the cycle, because typically, and what's occurring in the UK now, housing's rebounded very strongly because of the benefits of banks lending to housing, more people wanting to not live in apartments and moving outside the city. Working from home, people now able to work from home 1 or 2 days extra a week, which allows them to be more willing to work outside the city. And so there's this favour, people want to live in housing rather than apartments. Now, when things are hot in the building sector, your biggest cost is always materials and labour. Now, when things get really hot, if you can't access materials, you're going to start paying up for it. Now, Persimmon historically has seen this as a real issue for them, and they'd rather have some of that brick manufacturing capacity in-house, which they have. It allows them to supply themselves during the hot parts of the market, which allows them to maintain margins through the cycle as best as they can, whereas a lot of their competitors are not in that position. Even to the point that they supply, when they look at the risk of the business, they do master plan communities. They set up their own fibre company because they actually roll out the fibre themselves in these master plan communities. And then they basically on-sell that to some of the telco companies to manage the business or sell as an ISP over it. They've actually set up their own ISP because they weren't happy with the speed at which some of the suppliers, BT, etc., were moving to sell services into their master plan community. So they set up their own fibre company, which is in-house within Persimmon, which is, again, what it tells me is they're thinking about the customer and making sure the customer, when they sign off and handing over the house, gets exactly what they paid for. The other benefit, the opportunity within Persimmon is they have probably the longest housing land bank in the UK. It's about 5 years, probably the longest. And the reason they can do that is because they've got a net cash balance sheet. There is a holding cost in sitting on land because it's not producing any income for you. You actually sit on it until you get it rezoned and start pre-selling it and then building it. So it's all cost until you actually effectively sell the land. So you need to have a really healthy balance sheet. So that 5 years of land supply gives them options. that when things tighten up, they've already got the land. They don't have to buy in market today and pay up for land. But also it allows them to manage their product releases and product development through the cycle, where a lot of the other competitors are a bit shorter on land supply, so they're constantly having to chase the market when it gets particularly hot. More interestingly, and this highlights what's happened post the corona when starting to rebound, is the company did an update in mid-August where they actually said their forward order book's about 21% higher than it was at the same time last year. This includes the depths of corona. So it just highlights that Persimmon at this stage is in a sweet spot. Now, it is a really well-managed business. There's a new CEO that's come in to run the business. But I think we bought probably the best operator in the market with a great balance sheet. And this provides us with real confidence that the management, if they stick to their strategy, they're going to win over the longer run. Now, moving on to the next slide, I think it's important that, as I showed you earlier on with our global positions compared to other global domestic positions, we look at the difference between Persimmon and some of the domestic operators who are similar in a similar type of industry, home builders, etc. Persimmon, I said, has basically no exposure to apartments, whereas a lot of the Stocklands and Mirvacs, they have a higher percentage of their exposure to the apartment market. Now, the problem with the apartment market is it runs very hot, and then an overbuild typically occurs as things tighten, as the cycle rolls over, and then you can be left with a lot of stock. And particularly with the banks, I don't think they tend not to favour off-the-plan type purchases. I think the favourite is to be in housing because there's a land value there, etc. There's more robustness, and with that, Persimmon has very low exposure to that, so they're less impacted by the boom and bust cycle in apartments. Again, with the land bank of 5 years, allows them to future plan the business. So they're not in a position, and given the net cash nature of the balance sheet, they're not in a position when things get tough to sell off their land holdings. They actually can sit on the land and wait for the cycle to improve and maximise the value of the land holdings. When you look at the balance sheet, the reason they're in a net cash position outside of having an either experience during the GFC is that the return on equity or the return on invested capital in particular is in the 20s, 20%, which is where you want them to be when things are going well. They need to be generating 20% returns well above their cost of capital, which would be about 11%. That spread allows them to pay out a healthy dividend in particular, but also build cash in the balance sheet for a period when we have a crisis like corona. It allows them to sail through this time and take advantage of that on the other side. But for us, the most important thing is when you look at the management, they know what their expertise is, which is home building and dwellings. They haven't been tapped into commercial or industrial. They're very singly focused, and at least that allows us to know what we're going to get with Persimmon. You know they're a home builder. They're not going to drift off into other sectors because there's a bit of growth there. Because typically, if you're not best in class in those sectors, it can become future problems for the business. Now, I'd like to turn to the next slide. We'll just talk about the benefits of active management. Now, the volatility spike that we saw in March to August allowed us to reposition the fund and add quite a few new positions to the portfolio. We also doubled down. I mentioned earlier, we doubled down on a lot of the business we liked. Having that cash allowed us to do that. 50% of the portfolio as it stands today are actually new positions in the last 6 months. And that's having that high cash level and keeping an eye on stocks and being disciplined about what we pay for them. It allows us to take advantage of the market dislocation. You look at the global positioning, we went from a 7.8% exposure up to 26%. Again, I didn't want to sell our global positions. They're some of the positions we wanted to double down on. Fortunately, the board, in the middle of the corona crisis, the board decided we asked for to increase the exposure global up to 35%. And we've talked about this with the board. We assess it every year whether we should be doing it And the board's quick reactions allowed me to actually not have to sell our favoured offshore stocks, but also add new positions, as I mentioned earlier, Person and Auto Trader. And that greatly helped us because we added a real quality, increased the quality of the portfolio during the period when there was the biggest advantages. Again, I mentioned that having cash, that 25% cash, allowed us to buffer against that volatility in the depths of the crisis. And also, don't forget, as a listed entity, we try to maximise the franking available to our investors, to our shareholders. So we try to manage that tax actively, and we prefer to have the credits in the investors' hands rather than sitting inside the company. I'd rather pay it all out as fast as I can, given the time value of those credits. I'd rather it was in your pockets today. So we actively manage that so that we maximise the payment of franking credits to our investors at all times. Moving on to the next slide, just talking about the top 10 positions in the fund. I want to highlight the stocks we doubled down on, like Flutter, we doubled down on, it's now 10% of the portfolio. FDJ, again, we doubled down on. Austbrokers, which we started buying just before the crisis started, went from $14 down to $9. We doubled our position, so it's about 5% of the portfolio. A high quality business where people thought insurance broking was under significant pressure because of bankruptcies of SME, because Austbrokers does broke to SMEs, insurance products, and offers services to them, but that rebounded pretty quickly. And then we look at the newer positions in the fund. We're looking at Aristocrat, which went down to about $17.34. It's a high quality business, well managed, with a pretty good balance sheet. You know, it's a market leader in its industry, so we took advantage of that mispricing and added that as a reasonably sizable position in the portfolio. We added a media stock, HD1, radio operator, excuse me, radio operator. It also owns a quarter of a tech company where the PE is trading on a significant multiple. They've owned it for a long time. This business has really flourished. This tech company, Soprano, has really flourished during the lockdown. And then we've added Personal to the new position during the lockdown. Turning on to investment performance, the changes we made in March and April has now benefited the portfolio in the last few months, as a lot of those stocks have significantly outperformed the market. But given where we are today, the market's very close to highs globally. I talked about the narrow focus of the market in that a handful of stocks have driven a lot of this outperformance. So we feel that we need to really focus on the quality and value aspects. And to generate returns over the next 18 months to 2 years, 3 years, we're going to have to be willing to take a short-term performance hit, in my view, and buy some stocks which are out of favour today, but are reasonably good businesses, but are being overly discounted. But that will hurt us in the short term, but I think, again, that will genuinely benefit us in the longer term. So in summary, I'd like to highlight that being able to take positions against prevailing market consensus, but more importantly, betting against the structure of our market and the dislocation that's occurring, has provided the shareholders with some real benefits and performance in the last 12 months, as well as through the after-tax returns we've been able to generate through our dividends that we pay. We understand that the shareholders are very income-focused and tax-focused, so we hope to maintain that. Also, building the portfolio in a more balanced fashion, where we believe on an economic and industrial exposure, provides better opportunities to outperform over the long run. This has helped us outperform the market in the to September over the last 12 months by 13.5%, and actually generate a positive return while the market's still down. Lastly, I'd like to thank the shareholders for all the support of the company over the last few years. We had a tough few years there, but a lot of our shareholders stuck to and believe in our philosophy and our process, as we do, obviously. And that's come good in times of stress, where we think that's where the opportunity lies. And hopefully that we count on your continuing support in the future. With that final comment, I'll now hand back to Nancy. Thank you.